Hello, everyone. SD here for the weekly market update. This is March 12th, 2023. The market traded on the bearish side last week, with the Federal Reserve news highlighting the market until the end of the week. On Friday, the Silicon Valley Bank in California collapsed, with the FDIC stepping in to take over the bank's assets. Now, while this was a small regional financial institution regarding location, the impact was magnified for the market since the bank was well capitalized and heavily involved in investment banking for new technology as well as for crypto. So we have the second major crypto-felled bank. Ultimately, the major losses, indices lost about 4% of their value by the end of the week. So let's start with the Federal Chair Powell's 2 days of testimony, the biannual congressional testimony before Congress. Mr. Powell opened his remarks by saying that inflation has moderated a bit in the last few months, but there is a long way to go to get back to the target of 2% inflation, which is what the Federal Reserve wants to see. He also said that recent economic data has been more robust than the Fed expected, suggesting that the Fed may have to raise interest rates higher than the current target of the 0.5 or 5% range. However, by the end of the week, they'd probably modified that back based on what happened in the market last week to about 2.5 or 0.25. As expected, the market had a mostly adverse reaction, trading on the downside after these remarks. Jerome Powell's comments about stronger than expected economic reports were reinforced by the February employment report, released Friday morning. We anticipated this. We thought we were going to have upwards of about 250,000 new jobs, but there were actually 311,000 new jobs created in the month of February versus estimates of about 205,000. The unemployment rate did tick up a bit to about 3.6%, but many people were re-entering the job market, which showed just how strong the labor market remains, even with the Fed tightening on interest rates. The one positive portion of the report for the market was average hourly earnings, which were up about 0.2%. Not a lot, but still up. For the market, this indicated that wage inflation seems to be less of a factor in the overall inflation situation than it has been previously reported and previously thought. Now, back to Silicon Valley Bank. The market had started to become concerned early last week about Moody's information that the bank was likely going to downgrade by Moody's because the bank credit rating due to unrealized losses on the bank's balance sheet. On Wednesday, the bank's parent company announced that it would be holding an emergency sale of its stock to try to raise $2 billion to stabilize its financial position. That set off a run on the banks, about $48 billion, with many bank customers looking to move their assets elsewhere. By midday Friday, the FDIC stepped in, declared the bank insolvent, basically forced it into bankruptcy, and closed it in effect, making the FDIC the bank's bankruptcy receiver to distribute its assets to its creditors. The market reaction was to sell off at the end of the day, with the entire financial sector taking a really big hit. As many in the market suspect, other banks are currently at risk as they navigate toward the current environment, and we look to see potentially even more bank failures and closures in the coming days. Bottom line is the market will likely be very nervous as we start the week, with the financial sector at risk and coming under a lot of pressure. We could see a bit of a rally at some point, but we suspect the bearish pressure will continue and push back on that very quickly. For traders, the overall bias of the market may have changed from somewhat neutral over the last few weeks to a more bearish outlook. So be alert on the trades you're currently managing and be ready for stock repair strategies or stop losses if necessary. Remember, in a challenging market such as this, the main short-term priority sometimes becomes preserving capital, get some cash out of the market, sit on it for a few days, let's see what's going on. So there you go. The Dow Jones. So Dow Jones closed at 31,909, which is down 1,481 points, about 4.4% for the week. While the Dow traded all week bearishly, Friday's action pushed the index down even lower into very important support levels, about 3,200 or 32,000. Now, while there may have been an attempt to get back to the 32,000 level, we suspect this level will become resistance, at least for the short term. Our bias is on the bearish side. In the NASDAQ closed at 11,138, down 551 points, 4.7% for the week. The NASDAQ broke down through many support levels at 11,250 and is now threatening to test significant support at the 11,000 level. The overall chart pattern has turned more bearish, so we will move to be a more bearish bias for the short term. We should also mention that the two-day bullish engulfing candlestick chart pattern that we observed on March 1st and 2nd has now been negated by the bearish turn of events last week. So these chart patterns will never be a guarantee, just to be aware of that. The initial pattern showed that we had a sign of bullish, but that was turned because of the news of the week. Okay, now on to the SPY. The S&P 500, the chart broke through 9 levels of support in just a few short days, including the 20-day simple moving average, the 50-day simple moving average, after several hours of bouncing against it, and finally broke decisively down through the 200-day moving average after news of the Silicon Valley Bank failure and other bad news. So it's just too much sobering news for the market to absorb. Okay, look for tentative investors this coming week as the market absorbs the latest in the bank failures, and time will tell if this is a singular incident or a canary in the coal mine for more bank failures to follow. I tend to believe the latter rather than the former. For you probability traders, you want to sit out the next few days, maybe 3 days, to see how the market reconciles these events, see if there's more events compiling, while futures look to be pushing up for a rebound currently. It's going to be a difficult move to break through the resistance it faces in light of economic headwinds of the economic week. So if we take a look really quick at the chart, what we can see is we've got the 20-day moving average right here. Let's take a quick peek here while we're at it. So let me move over here. Right here, we can see right here the 20-day moving average on, let's see, at the end of the week, we were up. On Monday, we were bouncing against the 20-day. We was caught between the 20 and the 50-day right here. And really, it actually settled just below the 50-day moving average, at which we couldn't simply break above it. And then when we broke back down to 50, we broke down past the 200 with impunity. And that, to me, is a really, really strong bearish indicator. And then the following Friday, simply couldn't break above the 200-day moving average. And now we're sitting well below it. So be very aware of the amount of resistance in bullish attempts to move the market back up. I believe they're going to be futile, at least in the short term, until we reconcile what's going on with this bank data, and I expect to see more bad news to come. Until next week, fellow ghost traders, go out and make today your masterpiece, and we'll see you for next week's market update. Talk soon.